Hello, everybody, and welcome to another Pepperstone live session here to talk about 2 simple steps for better support and resistance. As always, guys, we'll be using the live market, which has been absolutely wild in recent days. And we'll be talking about some of the key levels we have hit and maybe some ways that you can more simply look at the markets. No doubt that 2025, as we've been talking about, is way more volatile than some people would suspect. We obviously did think it was going to be up, down, and all around with so many policy changes. But how do we cut through this? As we often say, if it's in the press, it's in the price. And that could be very true this year with so many movements that get confused by just the amount of information, the sheer overload that we're getting right now. I'd love to ask people actually that are here joining us today, have you guys felt like it's an information overload in 2025? If you have, put your hands up, let us know. It's always helpful for other traders and investors to be able to see that. And then, of course, get some information on how do we better cut through it. My name's Thomas Atkinson. I'll be joined in just a moment by Tyron Nabala, and it's great to have you here. We'll give a shout out to Michelle, Stuart, Damon, and I think also Thomas. Welcome, guys. It's awesome to have you here. Thomas says here, it's absolutely out of control. Markets are insane. Yeah, it's interesting that we think that, isn't it? Because really, yeah, in the crypto world, which I've got up here, we want to talk about this to start off with, then we'll go into stocks, then we'll go into commodities, and we'll go into obviously gold as well. We see a lot of moves here, but actually in the stock market, they're not as big as we would suspect. But the problem is because they whipsaw up and down, they're making it so that it seems so confusing. You know, which direction are we going? Are we range bound? Are we about to go into a recession? These types of things come up. Well, let's look at some of the key levels. So firstly, I thought we'd start here with Bitcoin because it's probably been the most volatile of all the pairs. You'll notice 1 minute it's getting absolutely collapsed on. The next minute it's rallying something like almost $15,000, and then it's dropping straight back down and then rallying again. So what exactly could we use in terms of a technique with support resistance that might be a little bit easier? Well, one of those is gaps. Now, support resistance generally is, of course, understanding of key levels where markets have bounced and the psychology behind that. And then, of course, key market levels where people have sold before. So there's a decent chance that they may sell again, and that causes a resistance level. But what about gaps? Well, something that people don't often use as much is the gap fills. And you'll notice here, we're in a unique time where we could trade crypto throughout, obviously Pepperstone's platform. And also there are futures contracts in the US and there's all these things. And of course, when markets are closed for the weekend, we get opens that can sometimes form large gaps. And this was one of them that we saw here on Bitcoin. And you can see there's a gap fill level at around 78,000, and probably not miraculously, it hit this level. Now, this is important because if you actually look at the S&P 500, which we'll do later on in our session, we'll talk about another gap that just got reached a few days ago and how it was reacted to. So one of the best techniques that you can use in support resistance trading or just trading and investing in general is to understand that gaps are a level of very big importance because basically price has completely not explored this zone and it is effectively filled above it. You think about it, closes here and then it opens up here. Well, what happens to all the orders that were in here? They get missed. So it's effectively what we call, a fair value kind of like a range that hasn't been made. So it's a gap in price where you haven't actually seen exploration of price action and what actually happens through that. And that's why you'll often see returns back to that. Now, a little known stat is that traditionally most gaps are eventually filled, especially the ones that are to the upside, but they can take varying times. Generally, most of them fill in less than 30 days. And actually the first week, the first 7 days is where the highest proportion of them are filled. So it's really great to use these knowledge points and, of course, break it down. Stuart says here, I ignore the news, so no information overload for me. Actually, your YouTube, which is something we do run, and obviously we do it here on, let me just quickly read this comment. Your YouTube and private community keeps help me grounded. Well, we find that quite a lot. Michelle says, what's your thoughts on the gap on Euro US dollar? Great question. We'll go through that soon. So first one, gaps. Gaps are absolutely underutilized. You can see here on Bitcoin and about to find out in the S&P 500 why they're so important. And what you guys may notice is there's a secondary gap. There's actually a gap over here between the break close here of Friday or Monday kind of level here, and then the market that gapped through just with probably like a futures contract kind of roll or something. So you get this gap and you've filled that. So why is this important? Well, we've seen a reaction of it. It's a well-known one. And when you see a reaction of this, markets will then move to generally the next level of equilibrium. Now, this is where support resistance, the traditional method, comes more into it. If we're going to see a market, let's say, react to this and we're going to see it go bullish, where is the level that is most likely going to be the placement of maybe a sell or maybe a take profit? Well, if you guessed maybe up here, then that would be a pretty good technique. What this is of course a support level, which you can see has been bounced off once, twice, 3 times, 4 times, and then 5 times over here. And this is really important because when you see a level like this being reached, hey Ty, welcome. Then basically we are seeing a zone where, because it's touched so many times, if the market's able to get back up to that level, there's probably going to be some sell pressure because people may want to take profit. They know this was a huge breakout zone. The market absolutely fell off a cliff, and then it's rallied back to that. And it's what we call role reversal, and it's a pretty good concept. Now, a little extra on top of the two things that we often talk about, and we're talking about here today, which is gaps and support resistance at key levels and role reversal, are these two here. So this is the moving averages. Now, we're using a 20 and a 50, which most of you guys that have watched these videos before would know. And when you have multiple moving averages sitting on top of each other, Ty, this is a point which can act as a good dynamic resistance or dynamic support, can't it? So it's a bit of a confluence that often does happen at these key role reversal.
Yeah, most definitely. And you can see it on the way up and it does it on the way down as well, just as easily. So we love dynamic support and resistance because it helps verify actually static support and resistance as well, quite often, especially when they overlap in a role reversal zone. It's really important. So yeah, I really like it.
Yeah, so very key level, great little extra bit of information there that I guess we can run down. So this is Bitcoin. It may pay, if you haven't already started to do this, if you've got Pepperstone connected to the TradingView platform, that maybe you also look at the futures contracts. And the reason you can do this is because you may not want to trade this way. Of course, there are roles and all sorts of things you may not want to do. But what it does help do is it helps to find these kind of gaps. So first up, gaps. Secondly, role reversal levels. And of course, moving averages. Now, I'll give another little tidbit for everyone here today. We saw an incredible rally, an incredible dump, and then we suddenly have started to see a little bit of a pickup. Now, the importance of this is when we start to go down to the smaller time frames. So let's have a look at a 2-hour chart here. And the reason we're bringing all of this up on Bitcoin is just because it's probably been the most volatile. So therefore, making sense of the madness is very important for us. And you'll notice that it comes down to this Fibonacci level, this 61.8 Fibonacci level. So this is a decent area to see some respect in terms of just like the markets, pulled back. What was the news? The news was the announcement of a potential crypto reserve. Realistically, I would have a feeling that if a crypto reserve was going to be in place, probably Bitcoin would be part of it. I think it's fair to say that if Bitcoin wasn't part of a crypto reserve, Ty, what kind of crypto reserve would that be? That would be a pretty bad crypto reserve. Now, of course, there's all been a lot of back and front too about this type of stuff, but generally speaking, I always see Bitcoin as the S&P 500 crypto. So therefore, when you think about it, it should respect these fibs as well. So fibs 61.8, the golden pocket sit between the Gann number and 61.8, always a nice level. And to see a bounce here makes some sense. We'll jump from crypto, though, Ty, to probably the other market that everyone's been going on about, which is, of course, the American stock market, which has seen all sorts of large moves. And I thought the first thing we might do is, again, talk about gaps, because you may notice there have been a couple of notable, really good gaps here in the past. The first one being this level. We can see here, just after the election, it goes from here to a massive rally. That then gets filled only during the start of 2025, and it bounces up, causing, guess what? Another gap. And the gaps, now, this is a thing, Ty. Do you prefer taking gaps from the close or gaps from just the highs of the day? So a lot of people think that's the gap. Do you think it's actually where the close is?
Yeah, look, I think the close is important. I think there's a case for both, really. I actually like to take the uncharted territory, so yeah, above the actual range of the day rather than the close, if the gap is big enough. But look, in this day and age, when When markets don't actually close that much, a gap is actually quite significant. And I think that's why I like the absolute range of the candle more. But again, look, when we first started trading, gaps were far more prevalent. Like you could see gaps everywhere. Weekends, in fact, you could almost anticipate them, couldn't you, Tom? Especially on some of the bigger, currencies. But these days, gaps are few and far between. So when they do appear, I think they're far more important, actually. So, I do like to see a complete clear window.
It's like, actually, when you think about it, Bitcoin's kind of going to the Wild West in terms of the gaps are more significant and huge because it's just so much more volatile. The stock market, while it has been moving down in recent times, and of course you look at that and say, my goodness, look how volatile it is. Again, we must put things in perspective. And I think that's the next thing I want to mention. But we'll just quickly look at this gap here. So we get the close. I do like the close. There is merit in both, as Tyron said. So generally, people will do one of two things. They'll say, okay, this is the high. Because price did reach those levels during that session, did it explore that zone? Did it explore those orders? And the answer is quite simply, yes, it did, because it actually went up to that price. So when it comes back down, it makes sense that this could be therefore the fill zone. Now, I do like the close, but both are valid and both have their own merits. So, of course, as Tyron mentioned, now that we've got more movement, it really maybe also pays to pay attention to what that gap was. Was the gap just a traditional day, which is Tuesday into Wednesday, or was the gap a weekend one? Maybe a weekend one, no expiration was had, so therefore you do need to go to the close price. I think that's a very interesting point. So either way, you'll notice here that we get down to this area, and guess what? We find initial buyers. Probably no surprise there. Again, another gap that's kind of getting things done over here. Another gap that's getting things done over here. A gap filled in terms of the high. Over here, it's filled in terms of the low. And again, you can see here, the gaps that have happened on the SPX, very good. Now, if you don't already do this, top tip is if you're using US 500 ETF CFDs with Pepperstone, then also look at the SPX. This is the, let's say, real market, although you could almost argue that the CFDs is the real market or the futures is the real market now, because of course it's trading so much volume through the after close. But this is basically where you see the market open to close in the traditional sense of when the New York Stock Exchange is open. Now, this could all change in the next couple of years, Ty, which is going to be wild. Maybe the exchange will actually broaden its hours, but still very important. And we've always, pretty much our entire trading investing careers, gaps have needed to be looked at and tracked.
Yeah, no, most definitely. Look, the S&P 500 finds itself in a very, very important zone. I think a lot of these indices actually do. I think the S&P 500, the Russell, the Nasdaq, even the Aussie market actually. I think the Aussie market is actually one of the most crucial zones with where it's at right now. We'll probably look at that tonight. I know we don't look at the ASX a lot, but it might be worth looking at tonight because it is at a crucial zone where a crack from here could see several hundred points fall. And I think it's no different for the S&P 500 here. I think if we get a break below 5750, we might find ourselves back at sort of that 5650 to 5600 very, very quickly. So it's starting to almost the rot's starting to nearly set in, isn't it? Like I know a lot of it's been mixed with, tariff news and, inflation news and everything else. But, at the end of the day, price action leads the way, and price action is telling us that it would want to hold up here. Because if it doesn't,
yes. Look at these levels. I mean, from a support level standpoint, we've basically got this little box here, and the market obviously pressured that box. 5,700 is a monstrous support. I mean, if this is taken, as we probably see on the ASX in a moment, then this is a significant shift of trend. There was a question here from Silvio saying, is this gap, or is this actually a gap right now? Well, there was one, Silvio. So this is the close. This is, of course, the open, and it went down and then rallied up to fill it. So it filled the gap in one day. And again, if you had that marked, so let's say we'd marked that through beginning of the session, you open here. If it comes back to that level, that may act as resistance. So it could have been a good short zone because the trend is clearly down. You may be expecting to go back down here or even to 5,700. So yeah, it's a very good observation and definitely something that has filled. If the market now, let's say, moves up, I don't know, by open to 58.50, you would want to mark this low out because that would be the close. And then the open would be over here. And of course, what you do is you then go to your 500 code and potentially trade it accordingly with it, along with other things. I want to point out as well, here we have, don't worry about the green line, but the red and the blue line, which is the 20 and the 50. Not only have we seen them cross, but we also saw the rally that came off this previous gap here hit that level, hit the resistance on the smaller time frame and sell off. So again, confluence of ideas. It's actually the exact same thing really as Bitcoin. So it's the exact same trade, just replicated in a different market, which is really cool to see.
The things we talk about all the time, the pullback to a zone like that, and the 20 and 50 moving average cross is an important one. Now, again, I'm not sure if we mentioned it last time on the S&P 500. I know we mentioned it on a couple of other different things, but the S&P 500 has not had a 2050 cross since the market was basically at 5,500. And realistically, you put this on a weekly chart, and that looks like a dead set head and more double top really on. You can see the last cross. It's a double top on a weekly, no question. And this is why this neckline here is very, very important. And really, the proofing pattern for that double top will be at around that 5,500 level. So very, very important to note that this base is a do or die level. It's one of the very, very important zones that if it breaks, I don't know what torque will actually turn it around and stop it from actually getting it to its target and probably overshooting a little bit.
I think it'd have to be tariffs taken off and deregulation and potentially taxation coming back into the fold straight away. So
it would take some serious move, yeah.
So because at the moment there is a form of there's a little bit of degradation in bullish sentiment. Now they often say whirl of worry, but there is definitely I saw the retail sentiment surveys from a lot of retail traders was one of the worst reads that we've ever seen last week. So I'm interested to see the data this Friday because I can only assume it's probably gotten a little bit worse. Either way, very big support. So I think as a support resistance trader, are you going to look at this as a very important point for bullish momentum? The answer is probably yes, because unless it's broken, there were buyers there before, there were buyers there over here, there were buyers there here. So what's to say they're not here? It's a very, as Tyrone said, critical moment for the S&P 500. So we've got another question coming in here for the ASX tie, which we'll see. It looks super weak, according to Thomas, and it looks super weak, and I'm not kind of like that keen on it at the moment. All right, we'll look at that in just a moment, and around the Russell as well. But we'll do the euro as well. So we'll do all these major pairs, guys. But let's just quickly go over to gold, because I wanted to mention gold from a support resistance standpoint. And obviously the key support here was right here. And what you'll notice is the gold reacted off that. So the reason we wanted to mention this is just because gold has been quite technical. Obviously it's been mostly bullish, which we talked about for weeks and weeks. We've been very bullish on gold from a sentiment and price action standpoint. But yeah, 2850 comes down, hits the support level, finds a little bit lower, presses that really low wick. So a lot of support resistant traders will just use the wick instead of the close. Up to you. Both have merit. Again, I like to just treat them as a range. So I just say this is a whole range. Easier done. And then basically you've seen the bounce. So if we're seeing the bounce, again, little resistance here, possibly resistance to 2950. Just dump silver for 1 sec tie, 32 plus broken through just before. Again, when you're looking at this on a chart, that broke a resistance, that broke a downward trend line. Is that significant? What do you think, Ty?
I think it's an inverse head and shoulders. I think it was a morning star on the daily. I think it had all sorts of things going for it actually for that break. So I think it was a daily that we had on a second ago. You can see a morning star pattern on it as well.
And we can go back to that. I was doing some beautiful drawings. 1 second.
I saw that. You were very quick on that drawing. It was very, very impressive.
Right. We're line drawers, guys. All right, so here's the pattern that you're talking about.
There's the morning star. So yeah, look, a lot of good things were in play at that point. And I think probably just as importantly, what we just talked about, and that is that it was coming off a role reversal zone. So you can see all you got to do is look a little bit to the left, and you can see that group of candles there was peppering the $31 mark as a level of resistance. Now we can see it found support there, and then off it went. So it came down, tested that role reversal zone, formed the morning star, inverse head and shoulders on the smaller time frame, and off it went. So no real surprises. And look, I think we've been saying for a little while, Tom, that silver has its place to shine. It's not only the shiny metal we talk about. Silver's got a little bit of upside too, but it needed to break that key zone, and it's done that now. So I think joining in the momentum is pretty good.
I want to give away a little extra tip on silver. So you can actually, in TradingView, you can actually go silver/gold. And when you do that, you end up getting a ratio. The Tyron said, like, there's shiny metal, but shiny metal's been a little bit less shiny than gold. And that's because it's behind. Take a look at this. When you zoom this out as a ratio, silver has actually been it's very low. So traditionally, silver should probably be more of an average of a 0.13 ratio. It's currently trading at 0.011. What's telling you is it's behind gold. Why? Well, there are probably valid reasons, but at the same time, historically, it's gotten back to this 0.013 many, many times in the past. And this can help a technical trader to really understand, when silver's super expensive, when it's cheap. If you go back to 2000, let's say 11, yeah, I don't think silver's a good buy. That looks like a really stupid idea. But if you're thinking about it now and you're looking at it, you're going, well, wait a second. If you actually go through all of the history, you'll notice this 0.013 ratio is hit a lot. So it's kind of like that happy medium between, overbought, oversold. And at this point, it's a little bit oversold. So again, a bit of catch up potentially there if you're looking at it from a multi-month perspective. Let's go to your favorite, Ty, the Russell. So you had some questions you had some comments on this one from a support resistance standpoint. So let's break it down for everybody. What are you looking at here?
Yeah, so the 2100 level on the Russell is an extraordinarily important zone. Okay. Can we just put a horizontal line right on that so you can show everybody?
You want a line? Yep.
Yeah, just a horizontal line right in the 2100 if we could. And then when we go, obviously we can see there's a lot of weekly action around that point. You can see we've got weeks at a time actually hovering around and touching that zone. And then, of course, when you go to the daily, you can see that it's a very highly interacted zone. And not only is it a role reversal zone, but it's also a very, very strong support zone in its own right, because every touch of this level has actually propelled it quite significantly higher. So again, it's one of those ones where I don't think that if this is a line in the sand level where if we see a close, somewhere between, I don't know, 2050 and probably 2080 on a daily, I think we're probably going to see a 19 very shortly. I don't think there's a lot stopping it actually getting there. So very, very important to keep an eye on the 2050 level, because I think if we get a daily close below it, it could spell back into the 1900s for the Russell 2000. This is a very, very important. You're going to hear that a lot tonight. Because I think a lot of the markets are at very, very important zones. I'm not sure if you've touched on oil yet while I was trying to fix my camera, but oil is, again, that's a massive line in the sand area for oil as well. So we will hopefully touch on that if you haven't.
I've been ignoring oil because I find it a geopolitical nightmare this year. But yeah, we'll look at it from a price action standpoint. I know the level you're talking about. So
yeah. So this 2100 is extraordinarily important. So a break of this level, and I think it's probably going to put the US on notice a little bit, I think.
And when we think about that, what you said about the importance of levels, we're seeing synergy. So we saw Bitcoin come down, crash into a gap fill. We've seen the S&P 500 hit 5750, 5700 zone, hit a daily 200, big deal. Daily 200. If you guys haven't done this before, put a daily 200 simple on your NASDAQ and specifically on your S&P, and you might be quite surprised. In fact, you know what? I've done it for you guys. Here you go. I cheated. There you go. So it's already here, but have a look at this. It is an incredible level over the last year and a half, 2 years. So is this an important level? I would say yes. What do you think, guys in the chat? What does everyone think? Silvio, Mitchell, Thomas, everybody else, Michelle, Stuart, other Thomas. What do you guys think? I'm sure there's many other you out there that haven't put anything in. It is a super important level, and this, of course, is such a great line in the sand to say, well, you know what? I do think this is critical, and it's hitting the 2100 on the Russell, and it's hitting key levels on the dollar and stuff like that. Let's actually have a look at the dollar, Kai, because we've got a question about that. You want to go to oil later, which we will. There's so much to talk about, guys. I mean, I was watching some of this whatever the hell it's called, State of the Union. I didn't know what was going on. It's like an hour and a half long, supposedly the longest ever. I don't know, it was an hour and 40 minutes long, but it was really long. And I'm not sure it really did much to the markets. But one thing is for sure, we suddenly saw what we've been talking about for a few weeks here. And that is, someone said the daily 200 on the dollar index. You are correct. That's absolutely right. You also dropped the anchored VWAP off the low there, as you can see. So yes, that is interesting indeed. But this dollar, Ty, this dollar is tanking the way that we thought it might. So let's go through this one and then switch into the euro. Thoughts on this?
Yeah, and look, it has been in a downtrend for quite some time now. Like, this is no secret. This has been trending down on a daily for quite some time. We've seen a series of lower highs and lower lows. We mentioned a few weeks ago we had a 2050 cross, and we also mentioned how significant that was, because the last time it did it, I'm looking at my chart now, was the market was basically 103.30 the last time the dollar index had a 2050 cross. So it was a significant level, and all it's done really is continue to do exactly what we wanted to do at this stage, which is actually continue in the trend that is prevailing, and that is a daily short. There's no worries about that. Are we going to find support at 200? Look, one thing we know for sure on the dollar index, the 104.20 area is an extraordinarily heavy defended zone. It was very hard to break through in the first place, and you're going to find it very hard to actually break through on the way down. So I think that every point that it has to fight for from around this 104.90 area all the way to 104 is going to be a very big and aggressive fight. There's going to be a lot of I guess reversals from this point. I would be very surprised if we woke up tomorrow morning and we're sitting at 103, because I think that zone is very, very heavily defended. So the 200 might catch it, but I'm not so sure, Tom. I think there might be another 50 or 60 points there before the real support kicks in on this one. And that often happens on the daily, on the daily 200 too. It doesn't always stop right on it. It's just really highlighting a zone. So you've got to be mindful of that as well. Quite often, even the last time it touched it, you can see there, it actually does break through by a little bit and then kick off. So it's not always the exact point. It is a very, very big moving average. You got to remember that.
Yeah, and it acts sometimes as incredible dynamic support and resistance. Sometimes it doesn't. I think with the NASDAQ was probably the key one, is it's happened so many times before. And we have actually hit a higher high. So at least if it's come down here, you've got to think maybe there's a little bit of overselling. I'll let everyone know today, $1.2 billion of retail liquidations happened in 1 hour through the US Open. Now, we throw around big numbers, but I think the importance of that is it's the highest in 10 years. That is the highest amount of retail selling, that is retail single stock selling, that happened for 10 years as it's been tracked on the S&P 500 single stock. So basically like the NVIDIAs, the Amazons, the Apples, and stuff. And that all happened in an hour. So you want to talk about capitulation. People freaked out yesterday for sure. And,
that's incredible.
I mean, that's incredible. That's a wild number. I don't know if I can show the chart here, but I can tell you it is over at FX Evolution on Twitter and or X, or what do we call it? And it's a pretty wild one. Check that out if you're interested. So yes, dollar index falling through. Let's go to the euro. So the question was here from one of the people in the chat. We had a question from, I believe it was Michelle. Let's have a look here. Michelle, did I notice the dollar index just hit the 200 SMA? Yes, it did. And then before that was Mitchell, actually. Oh, no, Michelle. What's your thoughts on the gap on the euro US dollar from Friday close and Monday's open? So I'm not sure if I'm getting this here. Jeez, I love this chart. I feel like this is something we've talked about for bloody 3 months. It's been a long time, and it's kind of nice to get a payout on it over that time, because it's been it's been patience. But the bottoming effect, if you're not aware of what we're talking about here, this is actually something that Tyrone and I have talked about now in terms of turning bullish on the euro and weakness on the dollar since the start of this year. And it's been a great technical lesson in having the ability to be patient, and the ability to also read price and hold the metal, because this is a little scary. Then this got improved, then this was good, and you can see how fast moves happen. I mean, just absolutely explosive over the last 3 days. I think the gap that we're talking about is this one here. So you would want to mark that out. Of course, you'd have it.
I don't think the euro hasn't had a move that significant. I think I'm just sort of going back through all my charts. I don't think it's had a move that's significant since 2023.
Let's have a look here weekly.
And even then, I think it's
these were huge, but this is a big candle, guys. This is a weekly big candle.
Yeah,
that's a big candle. That is showing flows. 2020 obviously had big ones.
Yeah.
What year did you say, Ty?
I said not since 2023, but that's probably understating it. I think it's actually further back.
No, I think you're right. This is a big candle. Let's have a look at this candle.
Yep.
It's a candle, or am I just going to highlight? What is this? What is going on here? I was like, how is that red? Why was that there?
Yeah, no, I
What
think this
is
is the
going
biggest
on?
candle. This is the biggest candle we've
That's
had
weird.
since. It's been a long time. Let's just say
Uh,
that.
it was. I was like, how is it red and it's going up? There was a
Yeah.
bloody line sitting on it from a million years ago. I'm sure that was a calculated line off the low because I remember this. Yeah, that's a big one. That's a big one. So this percentage wise is 2.22, which is a lot in the currency world. And because it's a lower, it's definitely more percentage. 3, but still big numbers. Yeah, you're right. I'd say it's the biggest one since this giant candle here in 22. And you got to remember, this is a good observation because what's it telling us? This could be the start of something bigger.
Started something big.
There's a
Exactly.
big ass flows.
Yeah.
Yeah.
And we are talking about one of the biggest currencies in the world, by the way. Let's not forget that. Like, we're not talking about, some small currency or some pair that has big moves because, there's very low volume. This is one of the biggest traded currencies in the world. So that is a significant move. Very significant.
And it hits the daily 200 as a few people have said. So yes, maybe we're starting to get into that resistance zone we've got up here. This is the resistance zone we've had in the charts, and was always our aim. We're starting to get up there, but I would say I would think an overshoot. Even if it does this, I'd still think this is the most likely scenario at this point.
Yeah.
It's been a trying year for a lot of things, but I still think currency might have been one of the better ones. I think that the problem with the stock market at the moment is like, wow. I think we had one day that was 1.5% down, then it went 1.5% up, then it went 1.5% down, then it went 2% down, then it's probably going to go 1.5% up. So the problem with that is it sounds great, but you're not getting that sustained trend, which is tradable, unless you're just like scalping each way and you're like, yes, and then that can also give you a hernia tie. you don't necessarily want to be there on those levels. All right, so let's keep going through the support resistance storyline. We've got up next is oil. So let's have a look at your thoughts on oil here, Ty. Let's go to the weekly. So this is the zone, isn't it, in terms of key levels? We had the doji before. We had a little bit of a scalp rally. We've seen horrible wicks. Look at this, horrible candles, and then we're down now at not even arguable. It's a key area.
It's one of the biggest key areas on oil in the last decade, and really, if it actually happens to break here, there's a long way to go. You have to go back a long way actually to see it below here. And its previous trend was around, you're talking into the low 50s if we can break this. If this level gets broken, you're really maybe into the 50s. And I know that sounds like an outrageous call, but let's not forget oil did go minus 18. So, I mean,
was it more than that? That contango, for anyone that doesn't know, check it out. Contango back in 2020, the contract for the month ahead went to negative. These are blends, these CFDs, so you don't have that problem. But the contango level, I think, hit negative 40, actually. I think it was. $40 negative a barrel was what you were paying. You were paying out just to get rid of your oil. It was crazy.
It was a crazy time.
It was negative $40 per barrel. It was an absolute nutter time. But yeah, Tyrone mentions here, there's not much support until here. And I'll put a chart that's the worst line ever. So we'll put an actual real one in. And that's going to be 58 and then even 51.
Yeah, you're in the 50s. And this is on the weekly, probably on the monthly. I mean, can we just go to a monthly chart for a minute? I know we very rarely go to a monthly chart, but on the monthly chart, you'll be able to see a very distinct descending triangle forming on oil. And its base is an extraordinarily strong one at around that sort of 67.50. So a break of this descending triangle will, most assuredly give it an opportunity to get to that 50-something mark. And that's crazy. Given, it wasn't that long ago we were looking at the 80s and it was looking quite strong, but by golly, it is really like this level of the do or die levels that we've talked about. This is probably the biggest of them all. Of all the do or die levels we've talked about tonight, this $67 mark on oil is probably the most significant, because if this fails, the ramifications for oil are going to be big. And of course, that in turn affects the stock market, of course, in terms of a lot of the energy stocks. So, its ramifications of this break are very, very important.
And generally speaking, as well, this is also going to mean yields could be dropping through the floor. Now you might think that's good, but actually that's going to not be short yields. That's going to be long yields. NY, 20Y, big long macro based yields that are going to mean possibly weak economy and a significant cut in the future due to lower growth. So a couple of things mentioned. We've got a lot of active people here in the comments today, Ty, which is great. Someone says, I think it was German news that pushed euro through. I think it was a mixture of that and just the market wanted to. Remember, as technical analysts, we're less interested in the why it's moving. We're more interested in the equilibrium flow from one level to the next level. So that we don't ever, in currency, we never want to try to pack in price. Just remember that. I know you know this already. And the reason is because if we try to figure out what the fair value of currency is, it doesn't really have one. It just tends to like float round, and we get like extreme highs and extreme lows, and it will often push further. There's a really good quote that says markets will do whatever it takes to make as many people look as stupid as possible. And I like that one very much because it's so true. Look at the last 2 weeks, guys. I probably wouldn't have thought that Bitcoin was going to take the low of the low. And then we get all these crazy announcements that we're going super negative, and then all of a sudden it's dumping down. Everyone on X is saying that the market is going to explode and it's the end, and then it rallies about $15,000 in about 3 hours. So it's making people look pretty stupid. But I think once you cut into it and you look at these more critical levels, like Tyron's mentioning here, it becomes clearer, and that's always cool. We love clearness. Clearness is good. That's why I've liked gold and silver, because they seem to be a bit more chill, actually, than the rest of the markets and currencies too. All right, let's move to the next one, which I think was the ASX 200 tie. Now, what I might do is I might load the XJO for a second. So again, for international audiences or anybody that's watching this that doesn't know what this is kind of like the market in terms of the open and the close. So you're going to have more gaps in this area. So Ty, let's walk through another key level here, and that's this one here, isn't it? It's the 8,080 kind of zone for the ASX 200. What's at stake here if we drop this?
A lot's at stake at this level. I think that I actually think that if we break this level down here, we're probably staring down the barrel of the 77, probably 7750, which is the next very strong resistance that was resistance, which should now be support. So we're talking several hundred points from here. It's peppering. It's trying very hard to do so. On a weekly, you can see it very clearly, but on a daily, you can see it just as clearly, and you can see the reactions off this zone. So if we go to a daily now, okay, so you can see how many touches. Just as importantly, remember what we talked about earlier. The resistance that was actually there prior to it becoming support is just as important as the support that we're talking about itself. So we've got the 1, 2, 3, 1, 2, 3 at this point now. And this is another, again, I told you hear it a lot tonight, a line in the sand level for a market that, could find itself falling 200-300 points very, very quickly if it does close below, especially if it closes below 80.50. And I think that's probably the key zone. I know it's tried very hard and it almost peppered it the other day, but it hasn't quite closed there. So wouldn't be surprised if we see a bit of a reversal from here and maybe pick up again. But I'd be probably looking at maybe shorting opportunities if it gets up above around those moving averages again. If it gets itself back up to the 20 moving average on a daily, I'd be looking for potential shorting opportunities from there, because I just think this looks weak to me. It looks very weak. The MACD is definitely on the negative. You can see that quite clearly on the histogram that it's very, very low. So that's the MT4 MACD that we know and love. You can see that's falling like a knife. That's extraordinarily sharp in terms of what it's done most recently. So I always look out for that, because that is the shorter term moving averages that are in play there. MACD, the MT4 MACD is made up of the 12 and the 26 moving averages, and for it to be so negative so quickly, I know we've obviously seen a short and sharp fall, but if you want to compare it to the short and sharp fall of the previous drop, the last time it touched this 8100 level, you can see that the MACD was nowhere near as low as it is now. So even though it fell nearly as sharp, if you look at the candles, it's fallen nearly as sharp and nearly as far, but the MACD wasn't as aggressive. Now we're looking at an extraordinarily aggressive MACD compared to what it did previously. And that to me is something certainly to keep an eye on, because if we get a break at this level, that is set to really set some rot in for the Aussie USD, the ASX, I should say, and 78, somewhere between 7,800 and 7,700 is where I see it.
And it makes sense as well that it could be really fast, because at the moment, we're not actually seeing a really wide breadth sell. We're seeing a lot of high gamma stocks selling in the S&P, at least. Obviously, Australia's a little bit different. But what that means is that if we actually see an all-market sell-off, which you may think we've seen, but we're not actually seeing it at all. There's a lot of stocks that are actually up, or at least sideways. Get that from the advanced decline indicator, which is an excellent indicator in TradingView. Then overall, this is super critical point, and it is again just the story of the day. Synergy across the board, everything hits. These markets are all intertwined with each other. In fact, great comment here coming in, which isn't the US dollar tied to oil? Well, yes, it is, because they're tied to yields. So remember that dollar is tied very closely to yields, and so is oil, and so are financials. So if we see a drop off in yield by too much, financials will suffer potentially. And then, of course, oil will generally be the one that moves the most. And you've got dollar as well. So it's very, very linked. Looks like it could be forming a megaphone, which is a type of pattern that kind of looks like this. So you usually get like that kind of thing. Not one that we use too much, but obviously a technical pattern that many people do use. Other big technical patterns people use, cup and handle. But the problem with megaphones, the issue we don't use with them is that you don't get those clear support resistance lines. And I think horizontals are easier. Because really, what is horizontal? It is showing you a psychological point in the sand. And when you think about buy prices and sell prices, I always go back to the easiest way to example this, Ty. When we did fund management a long time ago, if I said to somebody, we're going to sell the stock at $99.80, and they would always say, no, $100. And you'd be like, no, $99.80, believe me, is the best one, because we can see where the lines of orders are. No, I want $100. And that's because everyone is built into wanting round numbers. When you go to negotiation, generally people in a house or something, everyone will just go $5,000 or $1,000 or $10,000 increments. They won't go $400.66 or something like that. They're not going to do it. So the point is that we are this way, and therefore you always want to think about that back into the price action in these charts. So very important point here for the XJO or the ASX 200, and of course you can trade that with Pepperstone using the AEST 200 code, which gives you the futures. So ultimately, you can see here a bit more trade. You can see the way it's interacted with this zone out of market hours. You get the same kind of MACD. And we're pressuring it right now. So let's see how that plays out over the next 24 hours. Ty, guys, everyone, great questions today. I guess like to end the show here, if you have a few others, please ask them right now. But Tyron and I always like to give you guys a little bit of value in terms of what you're seeing and what you can kind of use as tips. So I think if I was taking something out of today, it's, start to apply the basics a little bit more. Roll reversal, okay? Gaps, certainly very good. Use those markets. Make sure you understand there is an old school here. There is the open and the close, not just the 24-hour market. So start to look at gaps, because people just miss them all the time. CME on Bitcoin, very good there. We've got, of course, moving averages. We've got FIB. Tyron's brought up a little bit of the MACD. If you want to get that, we like the MT4 MACD indicator, which of course you can get in MT4 and MT5. But at the same time, you can also get in TradingView by using MT4. And in general, I think the thing is right now is if it doesn't have your replication trade there, if you don't see the trade, if you don't say, this is the trade that I always take and I know is a good trade, don't do it. Come from the abundance mindset. You know how many opportunities there are in the next couple of weeks, in the next couple of months, the next couple of years? Obviously, you've already seen up, down, all around pancakes. So, basically speaking, there are millions. There's the millions, literally, of trades. There are always new opportunities. So never look back in the horizon and say, oh, I should have done this. What are you going to do about it? How are you going to change it? Should you have actually done it because your system was this way? Yeah, it means you failed it. You did fail the system. But if you were just going to take it because you had a gut feeling, not good yet, Ty. Gut feeling doesn't make you money.
Gut feeling is the worst thing in trading, I think. And I'm going to close out on that. Don't follow your gut.
Yeah, don't follow your gut, follow the price
Follow
action.
price.
All right, guys, that's it. We're gonna end it there. It's done. So give it a thumbs up if you're watching on YouTube. Thank you very much for watching. We really enjoy doing these shows. So make sure to, of course, join us every Wednesday at 8 p.m. New York time. Excellent interaction there, everyone, from your questions. And we will see you in a week's time to figure out what's happening with the crypto reserve and what's happening in general. But remember, ignore the news so much, follow the price action. Markets move from equilibrium to equilibrium. And the great thing is you can see that when you've got price on the left-hand side. So start looking more at the left than necessarily not paying attention to it. From all of us here at Pepperstone, thank you so much, and we'll see you in a week's time. Bye for now.